Virtually everyone in New Zealand is familiar with Kiwisaver. There's over 3.1 million people signed up to the scheme, and knowing exactly which fund to invest in can make a massive difference to your returns. Taking a look at a 20-year investment on a 60k salary with a 3% contribution, comparing a Westpac cash fund to a growth fund. So with this, there's a difference of about $25,000. So in that 20-year period with a cash fund, you'll have gained $74,000 versus a growth fund, which is just over $97,000. So in total, there's roughly a 25k difference between the two. So there's a huge change in how much money you have at the end of your investing journey, depending on which fund you pick. So it's really important to choose the right one. So if we increase the contributions up to 6%, the cash fund still doesn't have much of a change. There's $74,000 after 20 years versus a growth fund, which is $149,000. So the growth fund is almost double the return of the cash fund. These returns are so different because of the types of assets that each fund invests into. It's normally a combination of individual stocks, ETFs, cash and bonds, and depending on which fund, there's either going to be more or less of these different investment options in each one. All of these assets behave differently and give the fund its unique performance. Normally, a fund that has a greater percentage of its investments with cash will have a much more stable return. It's not going to have big jumps in price or big drops either. Normally it's described as a conservative fund. The biggest issue with these funds, as you saw earlier, is that they don't really give you much of a return. Normally with Kiwisaver, the main goal is to get your first home or set you up for your retirement. And this is a long-term goal. You have 10, 20, 30, 40 years to do this. So it's not really a big deal if you have some up and down price movements in your Kiwisaver funds. It's about the yearly price changes or the decade-long price changes, not the daily or monthly ups and downs. This is why I personally like a growth fund, because it invests more in high growth assets like individual stocks and also ETFs as well to help balance out the fund a little bit more. A growth fund can technically be more volatile, but in the long run you have a much better return, and the price difference even in just 20 years can be huge in comparison to just investing your money with a growth fund. I've been using Kiwisaver since 2020, and when I found out they were launching their own version of Kiwisaver, I was really excited to take a look at it. So with a combination of 5 different funds, looking at growth, balanced and conservative. One of the biggest benefits is that you can pick out your own investments and add them to your portfolio, so you have more control over where your money is going and the potential returns that you can make. On screen you can see a chart that will show the name of the fund, its management strategy, the returns that it provides, and of course the fees that it charges. Since the funds are new on Kiwisaver, there's not a direct chart that will show the returns that it has, but if you go to the fund provider's website like Sharesies, it'll show you the historical returns that the fund has had since it was first made, or at least over the past 5 years. So that's where these return numbers are coming from. So there's 3 different types of growth funds: the Pi Global, Sharesies and Pathfinder Ethical. There's also a Sharesies Balanced Fund and a Sharesies Conservative Fund as well. So the Sharesies Growth Fund looks like it's got the best returns out of all 5 options. Over the past 5 years, it's gone up 4.31%. It's managed passively, meaning that there's no one actively buying and selling the investments or choosing what stocks are going to be bought or sold to maintain the fund's performance. And it has an annual fee of 0.51%. We'll be comparing this to one of the best funds from Westpac, which is its growth fund. And with this example, it's also hard to figure out what the returns would be for someone who's picking out their own stock. So we'll just stick with the pre-made funds that are offered by Sharesies just to make it a bit more of a consistent example. So firstly, jumping into the Westpac growth fund, if we take a look at a 20-year investment of a lump sum of $10,000 and keeping in mind its 5.58% return and its 0.55 management fee, our total return would be $29,623. If we deduct the fees, it'll be $2,938 that we've paid out. So the net profit that we have after that 20-year period is $26,685. In comparison to the Sharesies Kiwisaver fund, which will give you a gross amount of $23,255, and you'll have paid $2,130 in fees. So the net profit is $21,124. So the net difference between the two funds after deducting the fees that they charge is $6,368. So you can see that a more established provider can be a bit more secure in comparison to the new Sharesies Kiwisaver providers. Lastly, we'll take a look at the fees for buying and selling your own investments. So firstly, if you're investing under $1,000, it's going to be 1%, and anything over $1,000 is going to be 0.1%. There's also an admin fee of 0.15 as well. And of course, each base fund has its own individual fees as well that vary between them. You'll be able to invest at least half of your Kiwisaver fund into individual companies that you pick out, and each individual business can't make up more than 5% of your portfolio. At least half of your balance has to remain in your base fund. But is there actually a much better investment out there that gives you better returns and lower fees as well? Reaching the goal of buying my first home was something that I always wanted to achieve. I knew that you would have to save up a lot of money over several years to get there, and the most practical option seemed like using a Kiwisaver scheme. But after breaking down the numbers, it seemed like such a slow strategy to get there, and it was also quite a hard pill to swallow that after you buy your first home, you can't touch that money until you've reached the age of retirement, which at the moment is 65, and who knows if that's going to go up in the future as well. And if you wanted to transfer your Kiwisaver money or your funds from one country to another, it seemed like a fair bit of paperwork to get this sorted. If you're just going to Australia, it's most likely going to be a bit more straightforward, but if you wanted to move across to another country that didn't have as much of a direct relationship with New Zealand, it was going to be a lot more of a hassle. Then I looked at the returns offered by the stock market, and the main thing that stood out to me and was mentioned over and over during the research process was the S&P 500. So this is essentially just a collection of the 500 biggest publicly traded companies in America. So if we take a look at the index, it's passively managed, meaning that there's no one being paid to select which companies are going to be included. They're just put into the index based on their market cap or the total size of the company. There's no fund manager collecting hundreds of thousands or millions of dollars a year to pick out investments that aren't really actually going to beat the average market return. And that is 10% per year, and the management fee is 0.03%. So you can't directly invest into the index, but instead you can invest into an ETF or an exchange traded fund. Essentially, it's a financial product made by big companies like Vanguard and BlackRock that allow regular retail investors like you and me to get access to these returns and invest into indexes like the S&P 500. So the main ETF that I like, which tracks this index, is VOO, or the Vanguard S&P 500 ETF. So if we compare the returns from the S&P 500 to a growth fund with Westpac, for both examples, it's going to be across 25 years with putting in $100 per week. But for Kiwisaver, there's also going to be a 3% contribution, and it's on a $60,000 a year salary. For Kiwisaver, you have a return after 25 years of $338,000 in comparison to the S&P 500, which is $472,000. So there's a difference just over $133,000. This really opened my eyes to the returns that could be made in the stock market and how it actually has the potential to be much more efficient than traditional investing strategies. But after finding this out, I still had so many questions like, what stocks should I buy? What's the best investing strategy? How do I even set up a brokerage account and start buying shares of a company? If you want to see a complete step-by-step guide to starting your investing journey in New Zealand as a complete beginner, then check out this video on screen, which will give you all of those answers and more.